just to give a little finance background first, it was in fact 640 BC that the first coins were invented, and here's a picture of those early coins. I imagine this was originally round, and therefore people have traded, bought and sold for thousands of years. The reason why this is important is if you think about the internet, how long has that been around? About 20 years or so, and look how that has advanced and changed all of our lives. But using coins, using money if you will, to trade and buy has been going for far longer. So that will be helpful for you to understand that this is a very mature industry, if I can call it that way, and that a lot of the techniques have taken decades or even hundreds of years to fine-tune to how they are used today. And money, of course, is the means by which other resources, people and infrastructure, can be acquired. Indeed, the invention of money, or more correctly, the evolution of using money, was important because it gives you the ability to store purchasing power. So money is the means by which the consumer, you and I, of other resources can be accelerators or deferred by borrowing or lending. What I mean by that, of course, is that when you've got money, you can gain resources right now rather than waiting for it, or by going to a lender or borrowing the money, again, you can defer how long it takes before you pay it back. Now, the gap between getting money and paying it back is important, and it's why a lot of these financial instruments, such as profit and loss statements, balance sheet, can confuse people, because there will be a different point in time from when you make products, when you sell products, when you get paid, or when you pay back loans. So keeping financial records has become much more sophisticated, and figures recorded by hand onto paper before computers became known as bookkeeping for the obvious reasons. Now, an important point here, before the Industrial Revolution, and I'm referring here to the UK, there were just simple trading businesses where investment was more than most individuals or families could raise. In other words, you might own a local bakery, and if you wanted to expand it, you'd have to look to other members of your family to raise money if you wanted to purchase a new building or to expand your current business. And this, of course, was where banks came into the picture. And back in the 1800s, the concepts of many people gaining a share of the business was developed. And what this means is it granted shareholders limited liability with the company, which was set up as a separate legal entity. And this idea of buying shares helped stoke the investment and use of money worldwide. Now, my brief overview wouldn't be complete without talking about fractional reserve and fiat money. There's been a lot of, frankly, bad publicity about banks over the past few decades, the boom and bust and the recent two recessions. Now, banks have got a good side and a bad side, and I suppose the bad side, around the 1930s in America, there was a secret meeting at a place called Jekyll Island where they got rid of the original gold standard and created what is now known as Fiat Currency. Now, fiat is a Latin term meaning let it become. The idea of fiat currency, nothing to do with the car company, is that a coin, when it's used, its value is defined by law rather than what its market value would be. For example, a gold coin would have a market value. If we were using gold coins, which we don't, then its face value could be worth a lot more than the value of the metal, if you will. So fiat money is based solely on the faith and credit of the economy, which brings me to the second side of this, fractional reserve. You see, fractional reserve banking is the current form of banking practiced in most countries worldwide. You'll be familiar with central banks. In the UK, it's the Bank of England. In the US, it's the Federal Reserve. And without going into the details, what has actually happened is they've abandoned what was known as the gold standard, where a bank would keep only as much money as it had gold, so that if there was a call on its reserve by those who have invested money or saved the money in the bank, they knew they could give it back. But fractional reserve means that, broadly speaking, that a bank can loan up to 10 times more than it actually has in gold. But it does get even worse. You see, every time someone takes out a loan in a bank, on the bank's computers, it creates that extra money, so that the result of everyone taking out loans, new money is put into the system. You see, what the bank is allowed to do is to create money to be able to loan it out to others. You see, just like the Bank of England or the Federal Reserve in the USA, it is they who print the money. So when anyone takes out a loan, let's say for £10,000, the bank creates £10,000 on its computers, not in real money, and that is what you will have to draw upon the bank and use that £10,000 to buy whatever it is you want. And that continues and continues. So this works when a bank accepts deposits from you, an investor, let's say. When they make loan or investments, the bank holds reserves equal to only a fraction of its deposit liabilities, providing immediately liquidity to depositors, in other words, around 10%. So while gold or silver-backed commodity money, or representative money as it's called, entails legal requirements that the bank of issue redeem it in fixed weights of gold and silver, that's not true for the money on their computers. You see, fiat money is currency that a government has declared to be legal tender, and fiat money's value is unrelated to the value of any physical quantity. So referring to the UK, money that banks create isn't paper money that bears the logo of the government-owned Bank of England or the Federal Reserve, the dollar in the USA. It's just the electronic deposit money that flashes up on the screen when you check your balance at an ATM. Now, I'm introducing you to these concepts first before we get into the finance itself, so it'll make a lot more sense when we look at interest-bearing accounts, when we look at paying interest, tax, paying liabilities and assets. So the numbers you see when you check your account, usually online these days, the balance, they're just accounting entries in the bank's computers. These numbers are a liability, or put more simply, an IOU from your bank to you. No real money is there, it's merely an IOU. So by creating these electronic IOUs, banks can effectively create a substitute for money, which they've done very successfully. It's no accident that banks are usually the tallest and grandest, most expensive buildings in any town or city. So by using your credit card or using internet banking, you can spend these IOUs as though they were same as in the UK £10 notes or $10 in the USA, for example. So when a bank makes a loan, it does not issue thousands of pounds worth of banknotes. Instead, it only credits your bank account with a bank deposit of the size of, say, a mortgage, if that's what you were getting a loan for. And let's face it, most of us on a personal basis is often things like cars or a mortgage or a home loan, if you will. And at the moment when a bank makes a loan, new money is created. And it uses the logical rule of supply and demand. The more money that gets created, the less the pound or the dollar or the yen in your pocket is worth. So you see, inflation is not down to people raising their prices. It's merely as more money is created, each pound becomes worth slightly less. And that amount is called inflation. So here's my last piece on the bad boys, the banks. Then I'll get back on their side and tell you how important they are to us doing business today. So by creating money, banks have increased the amount of money in the economy by an average of 11.5% a year over the last 40 years. And as a consequence, bank deposits make up over 97% of all the money in the economy. Only 3% of that money is still in the old-fashioned form of cash that you can touch, coins and notes.